right, we're going to go ahead and get started here. I know everyone's time is important and really appreciate everyone that's in attendance today. My name is Nathan White. I wear several hats that I'll explain here briefly. I've been a financial advisor for a little over 21 years now with John Graham and Associates. And my specialty, my niche, is working with employer-sponsored retirement plans. So I work with my own clients, helping them navigate establishing and maintaining a successful retirement plan. I work with my employers. I work with their employees, helping them sign up for the program, meet with them on a periodic basis, review their plans, and at some point in time, exit the plan with hopefully a successful retirement. I'm also here today representing Midwestern Securities. Midwestern Securities works with numerous banks and credit unions throughout the Midwest. And we support those advisors that are offering investment services, financial planning services, and retirement plan services to their commercial customers. So that's one of my other hats that I wear as the Director of Retirement Plans for Midwestern Securities. We've created some unique programs, retirement programs for our advisors. And I support most of our advisors in the field, being kind of the expert, if you will, behind the scenes on retirement plan regulations, updates, and the different programs that are available out there. And the other hat that I'm wearing is also as a business owner with both entities, John Graham Associates and Midwestern Securities. I'm also part owner of both of those companies. Under Midwestern Securities, I'm the Chief Financial Officer. I maintain our 401k program for our 20 plus employees that we have, as well as many other responsibilities from a business owner's perspective. So not only am I here talking to you as an expert in retirement plan space, an expert as a financial planner, but also an expert, if you will, as a business owner, and all the issues that we've had as business owners, not only in the recent past, but throughout the last couple of decades here. So today I'm here to talk to you about the Illinois Secure Choice program, and I'll get into that presentation here briefly. But again, just you can see my bio on the screen. My designations that I have, the AIF is Accredited Investment Fiduciary, and the CPFA, Certified Plan Fiduciary Advisor. Those are specific to retirement plans. So again, we're gonna use some of that expertise that I have and help you. Is our goal today, help you understand some of these new updates and these new regulations, and quite frankly, just arm you with some information and some of the best paths that we see out there, or other alternatives that we see for you out there. So that's our goal today. Throughout all this, our goal with any business owners is to try to make this as easy as possible. We know that you're busy running your business and you've got many other things on your plate. But we also know that, especially right now, attraction and retention of qualified employees is a front burner item. And retirement plans is usually front and center for that, as far as a benefits package for employees. That's what we're here for: help you understand what's available out there, what rules you have to comply with some of these mandates, and then what are some alternatives that you might want to consider and how we can help. So I am going to switch over to the actual presentation here. All right. So specifically what we're here today to talk about is the Illinois Secure Choice. And there's actually two legs of this, if you will. There's actually the Illinois Secure Choice Act that was signed into law in 2015. And I'll explain a little bit more about that, what that act is and what the regulation is with that. And then there's the Illinois Secure Choice Savings Program. So the act created the savings program, and they'll bleed into each other. Both of them are regarding the same mandate, but they're two separate legs, like I said. So, but I'll explain both of those here and what they mean, and we'll just get right into it. But before I get talking about the regulation, the mandate, and also the actual savings program that was created from the mandate, I want to start with the context, the problem, or the why, if you will. So the real reason for this and the backstory on why a couple of different legislators from the state of Illinois decided to adopt a program like this are we don't have enough people saving enough for retirement. And roughly about 50% of employees nationwide have access to an employer-sponsored retirement plan. So these numbers I'm going to put up on the screen right now are when this program was first enacted. These are the numbers from the state of Illinois. They had about 2 million Illinois workers that did not have access to an employer-sponsored retirement plan. About 150,000 Illinois employers did not offer any kind of retirement plan. And over 14,000 of those employers were at least moderate level as far as their employee base, 25 plus employees. This is the next 2 points here are the real reason for this is so not enough people have access to a retirement plan through the workplace, but research definitely shows that few workers save on their own unless they have something that is convenient, that is easy, that is a payroll deduct type of program. And research also shows that employees are 15 times more likely to save for retirement if they have access to an employer-sponsored retirement plan. So again, the state of Illinois took this data and made the decision that it's the right path is that we should have a mandate that all employers over a certain level of employee base should now offer a retirement plan to their employees. And again, the other part of this is when you look at the median, the national average out there of who is saving for retirement, we don't have employees, our employee or work base, if you will, saving enough for retirement. So that's the backstory of this. That's the why. And again, we can have a lot of other discussions on there's probably a lot more better options out there other than a state mandate like this is. But this is for employers that are headquartered in Illinois. This is what we have to work with the new regulations. So we'll go back a little bit. Like I said, the Illinois Secure Choice Act was signed in 2015. It was launched in 2018. And today we're here talking about it because it was updated at the end of last year, beginning of this year, with some new requirements, some new features as far as who's eligible or who's required to adopt this program. So when it was first enacted, it was for those employers that had 25 or more employees, and they define employees as full-time or part-time, doesn't matter. There's no hour requirement or anything. Just so you had to have 25 employees on your W-2 payroll. And you had to have been in business for at least 2 years. And the other criteria is you do not offer any other type of retirement plan, what's called an employer-sponsored retirement plan, to your employee base. So those are the criteria. That's the actual act of this is if you met these criteria, initially there was 3 deadlines based on the size of your company. If you had 500 or more employees, it was November 1st of 2018. 100 to 500 employees was July 1st of 19. And then 25 to 100 employees was November 1st of 2019. So the options were with this act were if you met these requirements, you either needed to enroll in the new Illinois Secure Choice Savings Program, or you needed to adopt your own retirement program. Or the third option is the state of Illinois would come in with penalties if you did not do either one of these, if you met the criteria. So the penalties for doing nothing were, and they still, for my knowledge, stay the same. It's the first year, if you'll be fined $250 per eligible employee. And then subsequent years, it'll be $500 per eligible employee is the teeth that the Illinois put into this program. So those are, again, that's the original version. It was originally rolled out, like I said, a few years ago. Haven't really heard anything until towards the end of last year. And what we've seen is an update to these rules now, and they've reduced the number of employees as far as the exemption. So if you're an employer and you only had 8, 9, 10 employees, you were able to be exempt from this mandate when it first rolled out 3-4 years ago. Now they're rolling in this, they're reducing that down to, eventually this will be, if you have 5 employees or more, you'll be required to follow this mandate. Again, the context with this is there's been a couple other states that have rolled this out, Oregon and California, and that was the threshold that they had put in place was a 5 employee base for their mandate that they rolled out. So Illinois looked at this and saw that they had some success with it, and so they've followed suit. So again, that's the main update that we're talking about today. By the end of towards the end of this year, November 1st of 2022, if you have between 16 and 24 employees, you'll need to do one of these options below. And then the second wave of this is by the November 1st of next year, 2023. If you have 5 to 15 employees, that's your deadline to adopt one of these options, which the options are the same as before. You either need to opt into the Illinois Secure Choice Savings Program, you need to adopt your own type of retirement program, or do nothing and face penalties by the state. So whether you have a retirement plan in place right now, or you're looking for a retirement plan, that's what we're here to kind of walk you through the next steps with this. First, we're going to talk about what is the actual Illinois Secure Choice Savings Program. So this is one of the options you have as a business owner. You can adopt into this, and you'll probably hear about this if you haven't already from the state of Illinois. They have some great flyers and educational material and sales material, really, that they'll send out to you that makes this sound like a great program. But we'll walk you through what it is exactly. And the program itself is very simple. It's a payroll deduct Roth IRA. So that means that you as an employer, if you adopted this, your responsibility would be to handle the payroll side of this, deducting the contributions from your employees. Being a Roth IRA makes it a little simpler. You don't have to worry about reducing taxes or anything like this. A Roth IRA is all after-tax money. But the idea is you would facilitate the contributions coming out of your employees' paychecks going into the Illinois Secure Choice Savings Program. And that's pretty much the bulk of your responsibility. The payroll deduct program is also an auto enrollment feature. Auto enrollment means all your employees that would be deemed eligible, again, this is part-time and full-time employees would all be deemed eligible, would automatically be enrolled at a 5% level. So 5% of their gross wages would automatically be deducted out of their paycheck and be sent into this program. Who's eligible? Any employees that are 18 and over, part-time and full-time are both considered eligible. So when the auto enrollment first is initiated, if you initially adopt this program or as you hire new employees, they have a 30-day window. That 30-day window, that employee has the ability to opt out. So if the employee does nothing, they'll automatically be opted into the program, automatically have 5% withheld from their paycheck. But in the future, so initially they'll have the option to opt out, and then they'll also have the option to opt out anytime in the future that they want to as well. Their monies will be that are automatically withheld from their paychecks will automatically go into what's called a target date investment. So the money goes into an investment account. That investment account is automatically allocated, diversified based on investments that are appropriate for the average person of their age. So a 25-year-old would be invested a lot more aggressively than a 65-year-old, for example. And those target date funds automatically adjust. They automatically update themselves as those employees become older. With this, because it is a payroll deduct Roth IRA, there is no option for an employer match. So there's no responsibility from you as an employer to offer a match, and there's no ability for you to offer a match. It's a pretty simple setup that only allows for employee contributions. The plan itself, the Illinois Secure Choice Savings Program, is administered by a company called Census. They're a large 401k retirement plan provider, but the plan trustees of this program are made up of a board of directors that are assigned by the state of Illinois. So the state of Illinois is not handling your money per se, but they do have direct control over this program with this board of directors. So that's it. That's what the Illinois Secure Choice Savings Program is. It was designed to be low cost, easy investment options, auto enrollment, Roth IRA type program for your employees. Now, the main thing we want to leave you with today is there are other options. The idea is sometimes we've talked to some employers that have heard about this from the state of Illinois, and the big concern we had is when they hear about it, it makes it appear that they only have the only option is the Illinois Secure Choice Savings Program, and that's not accurate at all. If you want to adopt your own retirement program, which many employers do, we can help with that. And these are the different options that you do have available to you. And we're going to break it down. There's some other hybrid type programs and some offshoots of these type of programs. We're going to keep it very narrow as far as the ones that we're most familiar with, as far as what probably 99% of our employers that we work with would work with one of these types of programs. The first one is called a simple IRA. As the name implies, this is a very simple program. It's kind of a watered down version of a 401k, and we'll get into some of the specifics, comparisons of this, and I'll hear it in a couple slides. The other version is if you adopt a full-blown 401k program. And many of us have probably heard of 401k. A lot of large businesses offer a 401k program. Both of these programs are simply employer-sponsored retirement plans that allow you as the employer to provide an avenue for your employees to save on a payroll deduct basis for retirement. Both programs also allow you as the employer to offer a match, offer a contribution in that program for your employees as well. There's a little bit of differences and nuances. Our company, for example, when we first started, we started with a simple IRA. It was a great kind of dip your toe in the water. We only had a handful of employees at that point in time, and it was a great solution for us at that point in time to get us started. Eventually, as we grew as a company, we decided that we needed to move into a 401k because there's a lot more customization, higher contribution limits, more customization with the match, those type of features that were a lot more attractive to us as a company. So again, we're speaking from experience, not only what we've done as a company, but what we've advised other employers to do as well. If you're a nonprofit, a 457 or 403B program would also be a qualified retirement plan. Those are only available for nonprofits and government entities, though. Last, and this is a little tongue-in-cheek, but even though the Illinois Secure Choice Savings Program is technically a payroll deduct Roth IRA, if you went out and tried to adopt your own payroll deduct Roth IRA or payroll deduct traditional IRA, which we've worked with some employers in the past to do, those programs would not qualify. So they would not count as an eligible employer-sponsored retirement plan. So you either have to adopt one of these programs above, a simple, a 401k, 457, or adopt the Illinois Secure Choice Program. Okay. So again, I wanted to kind of lay these out for you guys as far as comparing what a payroll deduct Roth, what a simple IRA, and what a 401k. And this is a fairly simple comparison. What we're trying to do is give you an idea what's the real difference between these. If you pulled back the curtain, looked at the nuts and bolts of how these programs work, this is kind of how they boil down to. They're all pretty much designed for employers of all sizes. With a simple IRA, you have to be an employer with under 100 employees to have a simple IRA. Can you offer another type of retirement plan? So typically when you offer a employer-sponsored retirement plan, you typically cannot offer another type of program. With a 401k, you have some customization there where you can add on other types of plans on top of that. So that's back to that customization with the 401k. If you have a simple, for example, you cannot have any other type of retirement plan. It's pretty cut and dry. So one of the main differences here is this who contributes item. So with the payroll deduct Roth, the Illinois Secure Choice Savings Program, It's only employee contributions. So only employees are putting money into this program. Where at the simple, you can, there's a requirement. Employees that put money in, you as employer will have to match those employees that are putting money in. So there is an employer contribution requirement with the simple. With the 401k, you have the option. All employees can contribute. It's up to them if they want to contribute. The same thing with the simple. It's up to them if they want to contribute. But with the 401k, you have the option if you want to offer a match or some other type of employer contribution. That's up to you. You don't have to, or you can have a higher contribution. You can fluctuate that from year to year if you want to as well. The maximum contribution, this is another one of the main differences between the plans. And you probably what you're seeing here is payroll deduct IRA is a very basic type of retirement plan, whereas simple IRA is a little more robust. And then you got the 401k that is the most robust out there. So you're seeing this here with max contribution limits. Roth IRA follow the normal IRA contribution limits, which is $6,000 per year. Unless you're over 50, then it's $7,000 a year. Simple IRA max contribution limits are $14,000 a year. If you're over 50, it's $17,000 a year. And then with the 401k, you bump it up to $20,500 a year or $27,000 a year if you're over 50. So these are just employee contributions. There's with the simple and the 401k, and any employer contributions are on top of these max deferrals we're talking about. Employee contributions, again, the Roth IRA is only after-tax money. That's the only option you have. The simple IRA is only pre-tax money. That's the only option you have with a simple. And then with the 401k, you have the option, or you and your employees have the option to either do pre-tax or Roth. You can do either one. You can have both as an option.
Nathan, we have a question in the chat here.
Sure.
Rick is asking, can business owners and or HCE participate?
Yes, that's a good question, Rick. So, and I'll outline them all. So with the payroll deduct Roth, yes, any business owners or highly compensated employees can participate in the Illinois Secure Choice Savings Program. But there's always a caveat with a lot of the stuff we say. Beware if you adopt a payroll deduct Roth IRA, it does follow the IRS Roth rules. So if your income is too high as a business owner or a highly compensated employee, you will not be able to participate in that program. So it really depends on your income level as a business owner or if you're considered a highly compensated employee. With a simple IRA, anyone can participate. There's no restrictions. Doesn't matter if you're a business owner or one of key employees. There's no restrictions there. And same thing with the 401k. There's some testing requirements, but that's something that we as advisors can walk you through. Typically, there's different features that we can add into a 401k that frees up you as a business owner to really max out your contributions if that's what you're looking for. And again, I just want to reiterate throughout all this, I know I get in the weeds a lot with all these details and logistics and so forth, but the bigger picture with all of this is attraction and retention of employees. That's the main feature we want to look at. A secondary feature that has been spending a lot more time talking about here recently is personal benefits to you as the employer. You personally as the owner, how much can you contribute? How much of a tax deduction can you get by making contributions to this plan? I'll talk about that a little bit later. I'll finish up the comparison here, but again, if you guys have questions, just go ahead and drop them into the Q&A or the chat section there, and we'll address them as we go. Employer contributions, like I said, the Roth, there is no employer contributions. The simple it's a cookie cutter, meaning you only have two options for a simple IRA. You either match your employees up to 3%, so 3% is of their gross wages, and a match means you only match those employees that put money in. So if you got half your employees put money in, the other half don't, you only have to match those that do. And that match is 100% dollar for dollar up to 3% of their gross wages. So as long as they do 3%, you have to match them 3%. If they only do 1%, you only have to match them 1%. The other option, which we usually don't advocate for, but it's there in case you need it, is a 2%, what's called a non-elective contribution. So that means everybody that's eligible for the simple IRA receives that 2%, regardless if they put money in or not. We're usually advocates for, we want to have those employees that put skin in the game, that actually contribute their own money to the program to get the match. And then the 401k is very flexible. So you as employer can decide if you want to put a match into the program, what's called a discretionary match. Discretionary match means you can change it from year to year if you need to. You can do what's called a safe harbor match. A safe harbor match really frees you up from all the testing requirements. You can do what's called a profit sharing. So the first two I outlined are matches. Like, again, you only put the contribution in for those employees that put their own money in. A profit sharing is like that non-elective for the simple. A profit sharing is everyone receives it that's eligible for the plan. My point with this is 401ks, you have a lot more features, a lot more flexibility. You can really design the match, the employer contribution to whatever level you want it to be. All right. Tax credits. So there's, we'll talk about tax deductions. This is your contributions that are going in, or employer contributions that are going in. There's, under the Secure Act, there was some new tax credits that were made available for employers that adopted retirement programs. So a payroll deduct Roth IRA, there's no administrative cost to you as the employer. Hard dollar costs. I say that again, knowing that it is administratively difficult for you to take the time and the payroll and so forth. But from a hard dollar perspective, there's no credits for a Roth IRA, payroll deduct Roth IRA. For simple IRA, these tax credits are available, and the tax credits are, basically it's up to $5,000 a year for 3 years, but it's an offset of any administrative costs and or financial planning fees that financial education, financial planning fees that your employees pay. And the same thing goes for 401ks. That tax credit is available for your 401ks. So I want to marry that one with the one at the bottom because of the cost. There's, again, the cost of these programs for a Roth IRA. Again, we're talking hard dollar costs. Are you going to get an invoice in the mail? There's no hard dollar cost for the Roth IRA. There's really no, you don't have any administrative costs. You as an employer for the simple IRA, your costs come in the form of the match that you're going to offer your employees. The 401k does have administrative costs to run the program. And so that's why I like to marry that with, we've seen a lot of employers adopt a 401k here the last few years because that tax credit helps offset those hard dollar costs that they've had to incur now to set up a program like that. So that's why it says low to high, depending on your plan provisions, how you design your plan and so forth. Most plans we see, it could be anywhere from $3,000 to $5,000 a year in administrative costs. These are hard dollar costs that come out of pocket for the employer. So tax deductions, go back up to that line. These are you putting money in. First, any employer contributions, you are able to take a tax write-off as a business owner. That's an expense to you as a business owner. So again, the payroll deduct Roth, there is no employer contribution, so there is no tax deductions. And with the simple, any contributions you put in personally as a participant are a tax write-off to you, and to the business, any employer contributions that go in to the plan are a tax write-off to the business. And that's pretty much the same thing with a 401k. You just have a lot higher contribution limits from an employer, how much an employer can put into a 401k than you do employer and employee can put into 401k than you do with a simple. So you have, if you're looking to maximize tax deductions, is what we're saying here, you might want to look at the 401k in addition to the traction retention parts of this. And the last one is vesting. So vesting is a fancy word for ownership. It means that how long an employee has to stay with you, employed with you, before they own the money that you have contributed for them. So again, the Roth, there is no employer contribution, so there is no vesting schedule. With the simple, there is no vesting schedule. That means those employees will own your match immediately as soon as it goes into their account. With the 401k, you have the ability, if you want to put a vesting schedule on in those employer contributions, you can. So we've seen, again, this is a wide variety. Some employers won't have a vesting schedule to do a safe harbor match, for example. Or some might have a 3-year, the employee has to stay employed for 3 years, 5 years, 6 years even. You can go out that long if you wanted to. So those are the nuts and bolts, if you will, kind of comparing the payroll deduct Roth with the simple with the 401k. Every company is a little bit different. Every company is different in their business cycle. You know, what might be right for them. I used our company as an example. We started off with the simple. We've seen a lot of companies when they first start off, a simple is a good solution for them. There's the costs are low. It's an easy program to run, and the out-of-pocket expense at 3% match is relatively easy for most businesses to absorb. With the idea that now you're offering a benefit to your employees. The 401k is an improved version of that, if you will, that allows higher contribution limits. You can put higher matches, employer contributions go into the 401k. One of the main takeaways is the cost structure of it. But again, with the tax credits, it might be something to reconsider. If you've looked at it in the past and passed on the 401k, you might want to look at it again with some of these tax credits and with this mandate. So here's kind of our opinion piece, if you will, on this, with why these other programs are, we believe, are much better for you and more importantly, your employees compared to a payroll deduct Roth IRA. I'm sorry, I got ahead of myself. When you talk about 401ks, I'm gonna back up a second here. I mentioned this a little bit earlier, but when you get in the 401k space, now all of a sudden you're adopting a program like a group health program that is regulated by the Department of Labor and the IRS. So it is a different realm from business owners, that now you have a whole slate of regulations that you have to follow when it comes to administering your plan, making sure it stays compliant and so forth. So that's one thing we've seen in the past for many years as business owners. Again, you need to stay focused on running your business. You don't have the time to be an HR manager to update yourselves on all the new rules and regulations. So that's why we created this special type of 401k about 10 years ago that really outsources as much of that legal and regulatory and fiduciary responsibility as we legally can. Really, the whole intent with this is to make it as easy as we can for you, so you can still offer this unique benefit, competitive benefit for attraction and retention. So that's what this slide is just outlining the CBAI 401k. That's one of the unique programs that we developed. That again, the whole benefit of this is it has all the bells and whistles and the same features of a 401k. We've married that with being able to outsource those responsibilities that would normally be on your plate as a business owner. We've outsourced them to either ourselves, our business, or to one of the other companies that helps administer the program with us. So 401ks are one of the most customizable programs out there. They have the most benefits, high contribution limits, being able to contribute pre-tax Roth, flexible employer match contributions. So we believe strongly in this, one of the best programs out there for a business owner and for the employees. Like I said, when you adopt the 401k, you've entered this Department of Labor, IRS fiduciary processes that's under these regulatory terms called ERISA, ERISA. And ERISA also helps regulate group health programs as well. So if you do have a group health program, you're probably familiar with a little bit of what we're talking about. And like I said already, the CBAI MEP provides the greatest amount of fiduciary outsourcing that is legally available within the 401k space. That's why we believe very strongly in this, especially for small business owners, freeing up your time to run your business and still offering extremely competitive program. So it really, the main responsibility as your business owner with this specific program is just updating, sending in payroll contributions and updating employee census information, hires and fires, and wages that employees make and hours they work. All right, so now we'll get into my opinion piece, if you will, on why we believe these adopting a simple or 401k, we believe very strongly is much better for you and your employees versus the payroll deduct Roth IRA. And I want to give some context because we've been able to work with payroll deduct Roth and traditional IRAs in the past. So we can offer these types of programs, but traditionally we've always led with a simple or 401k, and these are the reasons why right here. There's a lot more control by you, the employer. This is your program. It's not administered by the state of Illinois. You get to assign who you want to work with. You get to assign the program you want to work with. So you have that control, and there's a lot of features that you get to decide on what you want to do versus a payroll deduct Roth is the same regardless of what company you work for. One of the biggest features of this and one of the biggest game changers, back to what we said earlier, I started this presentation with what's the problem? The problem is people aren't saving enough for retirement. And not enough people have access to employer-sponsored retirement plan. If they do, they'll a much higher chance they'll save for retirement. But even if you have someone putting in 5% a year, and they adopt the Roth IRA, they put in 5% a year. Yes, that's a decent start. But when you look at this from a financial planning perspective, people really need to be saving 10 to 12% total in order to be able to replace their income once they get to retirement. So you're going to set up a retirement plan, and people are going to be putting in 5%. In their minds, they're going to be thinking they're doing enough. They're going to be able to replace their income when they get to retirement. This is going to get them there, so to speak. When they get to retirement, they're going to come to the realization that they still haven't saved enough. So an employer match is a great way to overcome that obstacle, helping those employees get to that 10% level. If they can put in 5% and you put in 5% match, they put in 5%, you put in a 4% match. That's a lot closer to that 10% level than them just putting in their own money. So the employer match, and the other biggest benefit, the other biggest point about this is you're going to see a lot more employees participate in a program when they receive free money from their employer. And they're going to see this and it's going to be perceived as an actual benefit. If they're just putting their own money in a retirement plan, they're not going to see that as a benefit at all. So it increases your chance for employees to be able to retire successfully. It increases the buy-in from employees wanting a career. We've seen this over and over again. Those employees, we have several employers out there that have turnover issues. And we've seen it traditionally that those employees that sign up for the 401k are those employees that make this a tenured career, that they have a lot lower turnover ratio with those employees that sign up for a benefit like a 401k. And it's increased appreciation of employees as a true benefit. Like I said, if you're signing up for a program where they're just putting their own money in, it's not going to be perceived as a benefit. You give them money in the account for them in a match, they're going to definitely see this as a benefit. It's going to help you attract those employees that have a 401k with another provider, another employer, or it's going to help keep your employees. Pay is always going to be the number one reason that employees are shopping around, but healthcare and 401k are a close second. So this is just another way for you to help for attraction and retention. Much higher contribution limits than a Roth IRA, any kind of IRA out there. So it allows you to be able to put more money away personally yourself, allows your employees to be able to put more money away for those especially for those key employees that really want to max out their contributions. And it's a tax write-off, as I mentioned earlier. This tax write-off under the Secure Act, it gives you that tax credit for the administrative expenses or education and financial planning expenses within the plan, up to $5,000 a year for 3 years to offset those costs. We will put the caveat to this: that does not help offset your employer match. Unfortunately, it's only those hard dollar administrative costs. And of course, you're able to work with us, the advisors. If you go with the Illinois Secure Choice program, you get an 800 number. You're working with someone from a call center to help you out with what you need. When you have issues, that's who you're working with. When you work with us, you're working with local experts in your community, people that will come to you face to face, help you work through the issues you're having, and more importantly, help your employees out with what questions they have, helping them understand this program. And again, we've seen this time and time again, when we go in, we help educate your employees, we help enroll employees. They see this as a much improved benefit and a key benefit versus just here's a form, fill out a form, or here's an 800 number, and here's how you enroll. So it's, working with the advisors are going to help your employees understand this benefit and help them make it as easy as possible. All right. So again, just in summary, the Illinois Secure Choice Savings Act started in 2015. They just updated it this year. So if you got any 5 employees or more, then you want to pay attention to this and look at. You'll have a timeline, either adopting that Illinois Secure Choice Savings Program by November of this year or November of next year, depends on your company size. Or we can help you out with helping you to look at other types of retirement plans that would meet the requirement, and quite frankly, be a much better program for you and your employees. I'm a resource for anyone on the call today, but I think a lot of you are in attendance with one of your with your local bank, with one of your advisors, that sort of thing. So reach out to them. Set a meeting, talk about what plans might be appropriate for you, and then of course I'm helping them behind the scenes if we need to be pulled into a planning meeting to help you out as well. So my contact information is on the screen here. If anyone else has any questions, go ahead and go ahead and type those into the chat or the Q&A right now. We'll give a few minutes here and be available for any questions you might have.